What is up, Eagle Investors? I hope all of you are doing well. Welcome to another episode of Eagle Investors Market Recap. In this episode, I'll be going over the crazy market that we've been seeing over the past few weeks, as well as specific plays which I think have an opportunity to grow based off the current macro environment that we're seeing. I'll also be going over specific commodities and specific trends that I'm seeing in the markets overall. To start off, the S&P 500 versus the Russell 2000, this is a measure of seeing how small caps are performing compared to large caps. And we're seeing the S&P 500 actually outperform the Russell 2000 by approximately 75 bips for the month overall. And this trend is significantly different from what we've been seeing year to date. But I believe the correction that we're seeing was primarily due to the fact that we're seeing rising yields, which are hurting many of the growth companies within both of these markets. So I believe that as a result of rising yields, we're seeing a higher cost to borrow rate, which hurts many of these companies with high price to earnings ratios. So that's a trend that we could potentially continue to see if we're seeing increased inflationary pressures moving forward. For the year to date, the Russell 2000 is continuing to outperform the S&P 500. It's up approximately 11%, while the S&P 500 is up approximately 2.5% for the year to date. And I think this trend can potentially continue as a result of the continued vaccine rollouts, the fact that we're seeing continued monetary and fiscal support, and also due to the fact that we're seeing that potential rise to the normal, helping many of these value plays in particular that might be able to see extreme growth, especially within the Russell 2000. Now, the play that I think has tremendous opportunity moving forward is Prosperity Bancshares. The ticker is PB. The reason why I think this bank in particular will be able to outperform many other names is a result of the fact that we're seeing rising yields. This means that regional banks in particular might be able to outperform many of these other names since they can charge higher interest rates for their clients. Now, for a bank like Prosperity Bancshares, they're able to charge those higher rates and in turn make more money. And this is significant because many of these regional banks make up a large portion of the Russell 2000, which is why I'm so heavily bullish on the Russell 2000 moving forward, because I only see these yields continuing to go up as a result of increased inflationary pressures moving forward. Now, in terms of the U.S. 10-year yield, we've seen the U.S. 10-year yield balloon over the past month, which has hurt many of these growth names. Like I said before, a higher yield makes it more expensive for many companies to borrow money, and that in turn hurts many of these growth names with high price to earnings ratios. So it's definitely a number to keep an eye out on. I believe if the US 10-year pushes past that 1.75% level, we'll see a continued sell-off in the market. And I think tech in particular will continue to get hit hard as a result of having that higher cost to borrow rate. Now, as a result of the increase in the US 10-year, we're seeing an increase in the strength of the US dollar as well. Now, this isn't only due to the fact that we're seeing an increase in the US 10-year yield, but it's also due to the fact that we're seeing a rise in non-farm payrolls as well as a rise in employment rates. So it's definitely going to be something to keep an eye out on. If we see the US dollar continue to improve, that means that we could potentially see commodities such as gold continue to lag in terms of performance, since the dollar in gold have an inverse relationship. So that's something to keep in mind. And over the past few weeks, we have been seeing increased selling in the markets. So that means some institutions might have to sell some of their positions out of gold because they might be getting margin called in other portions of their portfolio. Now, crude oil has been something that's been of interest, especially for the past couple of months. We've seen a dramatic rebound in the crude oil prices, and this is primarily due to some of the supply cuts that we've been seeing. In, in particular, something to watch for is the cut that OPEC has agreed to make. They have decided to not increase the supply of oil in April, and this is leading to a substantial recovery in terms of the price. And also, we're seeing more optimism in terms of increased demand with the vaccine rollout and optimism of things going back to that normal. So that's helping helping drive up the price of crude oil here. Now, like I mentioned before, we're seeing an increase in non-farm payrolls. Non-farm payrolls came at 379,000 versus market expectations of 182,000. Now, this is really good to watch for as we're seeing an increase in employment, in particular within the leisure and hospitality space. So what does that mean? That means that many of these leisure companies are starting to rehire, and there could be an increase in demand within these specific spaces with specific regions within America starting to open up. I know, for example, we've seen Texas come out and saying they're opening up many different branches, so they're trying to get to that new normal as soon as possible. So that's something to definitely look into, and I think there will be many names that, in particular, value names such as Boeing, Lockheed Martin, Las Vegas Sands, and many other hospitality or leisure companies that continue to rebound with this vaccine rollout, as well as fiscal and monetary support. So that's something to definitely watch for and see if there are any buying opportunities with the market dip. Now, something I wanted to mention in terms of the VIX term structure, it's currently in contango, which means there is fear in the market. As you can see, the contracts that are in the future are higher priced than the contracts today, which means that there's more uncertainty in the market moving forward. This signals that investors are buying, they're trying to protect their portfolio, and they might be buying puts to protect their portfolio, or they're just expecting more volatility in the market altogether. So that's something to definitely watch for. Make sure to understand that cash is a position and you don't necessarily have to open a position. And try to make one thing we do here at Eagle Investors is tell members not to invest more than 5% of their portfolio in any particular position. So try to tread lightly. And in terms of holding long-term names, if you believe that the company will continue to be solid and you believe that their investment thesis still holds, you can hold those long-term names and you could potentially even buy them up. But in terms of short-term trades, just try to tread lightly and understand the risk that you're taking with the markets being so uncertain here with that rising US 10-year yield. Now, like I said before, keep an eye out for that 1.75% number. And if we hit that, I potentially think we can see a further correction within the tech sector in particular. So keep an eye out on that. Make sure to tread lightly and play the market safe. I hope all of you are still holding many of your long-term positions or holding cash as well. Try to avoid panicking and selling your whole portfolio, especially if it's something like a 401k or something like that. I believe that we can see a large recovery moving forward. So keep that in mind, and I hope all of you have a great trading week next week.